Alrighty, so the first exam's behind us. I was looking at scores. Everybody looks like they got it completed, so no issues there. I'm going to go back through in the review part. Again, I think, I don't think anybody should have too many complaints with the review, or I don't think anybody should have any complaints with, kind of giving you some pointers on the test because this is the important stuff, and this is life here, opportunity cost. If you're doing something, you're not doing something else. Anytime you're out, whatever. And the same is true with money. If you spend money on something and you go, I don't have any money at the end of the month, well, that's because you spent on something else. Fair enough, but you know, it's your life. Do what you want. But some people are going to do well, and other people are going to be, living paycheck to paycheck. So anyway, uh, another opportunity cost. Yep. So trade-offs. Retirement planning as soon as possible. Again, it may not seem like a whole lot of money, but man, I'm not advocating Bitcoin. I'm not giving advice here. In fact, right now, if you know anything about crypto, you kind of got to buy the dips, and this is not a dip. It's going well. I mean, it could go much higher or it could drop back down. I'm thinking about selling about half of mine when it hits a new high around about 75,000. But I'm not even sure if I'm going to do that. If it looks like it has momentum, I'll stick with it. But it's kind of fun. Um, Investing is fun when things are going well. Although the stock market, whew, I'd be a little right now is kind of a nervous moment. I don't see a lot of good things going on in the economy and a lot of reasons for optimism. But anyway, there may be some opportunities to jump in if things go the way that they're probably like to go, which is a pretty big drop at some point here in the near future. But anyway, you can look online. You can find people forecasting. Oh, this is it. It's all going. It's all going to drop, and whatever. They're wrong 99% of the time. That one, they put out these videos every week, and then the one week that it does happen, they're going to claim that they were, prescient. They knew what was going on. Anyway, okay. So if spending exceeds the amount of your income over time, best option is to reduce your spending. That's really the only option. You can't sell stuff. You only got so much stuff. And increase your work hours. Yep, we got a dog fight ensuing behind us. If it doesn't break out, throw in the towel. No, unwarranted. Which of the following is a liquid asset? So cash in a savings account. That is a liquid asset. Student loans, car loans, what do these all have in common? They take over a year, right? So that is a long-term liability. Remember, 1 year is the defining thing for short versus long-term. Best measure of a person's wealth is their net worth. So, assets minus liabilities, right? Somebody's living in a huge house. Well, if they're completely in debt doing it, it's not necessarily a bad strategy. I mean, if you're going to be in debt for something, real estate's not a bad way to go, but it doesn't mean you're wealthy. It's only when you start earning some equity or maybe that house starts appreciating and it's worth way more than your loan. Well, that's cool too. So anyway, why is it important to monitor your debt level so it does not become so high? And do not, this goes hand in hand with credit ratings and the rest of it. Don't think that the banks are, oh yeah, you can't pay this back, so we aren't going to make the loan. That happens once in a while, but there's always somebody, especially in the credit card realm, that will allow you to get way in over your head. They don't care. Um, Money received, so this is, time value of money because it can grow at a compounded rate. Compounded rate means earning interest on interest. Same question. So again, if you kind of have these basic concepts down, the test should be fairly repetitive. And that's not necessarily a poor test. It just means that there's certain things that you really need to know in life, or else it's not going to go well. Earning interest on interest, again, compounding. Head of household. So, you know, the least favorable category out there is single. And if you do have people dependent on you, dependent children that are, not being claimed by somebody else or other situations where you can get out of that single category, do so. And so, unless you're in the traditional married category, if you're a single person, if you've got some sort of dependency situation, then you'll definitely want to claim head of households if you can. Here's a lady. She bought some General Motors stock 7 years ago, so it's going to be long-term capital gain. 2015, she sold it for 35,000, so good on her. 15,000 capital gain long term, obviously, since it's more than a year. Purchasing with credit will help reduce your tax bill. Yeah, none of that consumer interest, boats, all that stuff, credit card, that went away before I was around. Even they back in the 70s, they got rid of consumer debt being tax deductible. Now it's real estate. So, the real estate, they've got a great lobby, and you'll expect those tax benefits to accrue. There's other things we can talk about. There's ways that you can sell real estate, and if you've lived in it 3 out of the past 5 years, you walk away from it without paying any taxes. There was a Roth IRA that they're trying to kill, and some other things. But anyway, it's not just making money, but it's holding on to it that's important. And so, I mean, I'm a farmer, and I don't make much money on farming, but man, I can lose a ton to the point where I have very, very attractive tax write-offs. So, there's certain strategies that you employ to minimize your tax load. Financial institutions loan funds at a higher rate than they pay their depositors. Your ability to cover any short-term cash deficiency is called liquidity. So again, cash. Cash is, or cash equivalents, but not something like real estate because that's very hard to change into cash. Disadvantage using credit as a source of liquidity is the potential cost of finance charges. Yep. Stopping payment on a check, yeah, it has to have not cleared. Now that's kind of a tough thing now because checks are. There used to be a thing called a float where it took a while for the check to arrive at the bank. Now, it's almost instantaneous. It's like a debit card type thing where it's processed digitally rather than a paper check arriving at the bank. An arrangement that protects a customer who writes a check is overdraft. So anybody who lives a normal life will have an overdraft at some point. And whether this ends up being, 50, 75, whatever. I mean, you screwed up. They own you and they can charge you whatever they like. So you need to have some sort of overdraft protection because it's going to happen. If you're somebody who says, "Oh, I'm going to keep $10,000 in my checking account and this will never happen to me," well, guess what? Identity theft will happen to you and you'll lose that $10,000. So that's not a good strategy either. All the following situations are valid reasons to borrow funds except borrowing for every day. Yeah, it's kind of insidious, but if you're not able to make ends meet, you got an issue. When paying off your credit card frequently, it is wise to pay off the balance every month. Yeah, a convenience user. You're just there for the miles, for the perks, for the availability of being able to get, rental cars and hotels for cheap without a deposit. You're not one that's paying their, 20 some percent interest rates. Which of the following is not true regarding cash advances on credit cards? They are treated just like, no, they are not. You are going to pay a charge. You're going to pay interest from the time you do it. There is no such thing as a convenience user on a cash advance. So again, the different terms of credit cards will vary, but I don't think there's a one out there that has that. Which of the following is true about bank cards like Visa and MasterCard? Excellent source of emergency funds. So yeah, use the credit cards and don't let them use you. Finance charges apply only to balances were not paid in full, and that's typically true. Read the fine print on the thing, but yeah, almost any card, pay it off before the statement date, get it back down to zero at some point during the month, and you owe them nothing. If every time you're checking your statement, look at the finance charges and make sure it's all zeros. If it's not, then figure out what happened. Next one. APR, annual percentage rate. Good practice to review your credit card statements to make sure they're correct, no duplicate charges, and monitor spending patterns. All good stuff. Collateral. Collateral is it's a good thing. It's what makes the loan affordable. It gives the lender an additional recourse if the payments are not made. So you want a collateralized loan. You don't a signature loan because it exposes the lender to more risk is going to incur a higher interest rate for you. Which kind of loan generally has the lowest interest rate? The secured loan, secured by collateral. So it's all related. All the following true except a cosigner. So the lender may not seize, the lender will seize the assets of the cosigner because you're the one that was, you had the money to, to qualify. You got the good stuff. The guy who can't get it needs a cosigner. If I'm, like Dog the Bounty Hunter and I'm out trying to get my money back, I'm not going to go after the guy who needs a cosigner. He probably doesn't have very good stuff. You probably have a home, probably have some other things that you can easily attach, put some liens on, and you'll pay. Um, when purchasing a home, which of the following costs will you not incur? The commission. So you'll see some changes over the course of your lifetime. Right now it's 6%, so it's a big deal. If you're selling a home, you know, it's painful. But if you're buying, hey, that's a seller cost. It does not accrue to you. One disadvantage of the neighborhood homeowners association, there's many, but anyway, covenants can restrict. But yeah, I mean, it's a good thing, bad thing. You may be part of a homeowners association. You may have other issues, but I always tend to do things that are, put me afoul of the homeowners association. I do not want that. On a fixed rate mortgage, the monthly payment remains the same constantly. So unlike rent, if you're looking at, well, to buy a home is going to cost me 2 grand. I can rent this thing for 1,300. Well, within a couple of years, your rent's going to be 2 grand, and your mortgage payment's still going to be 2 grand. So you could have owned the thing. Adjustable rate mortgage. You'll see other acronyms pop up if interest rates, inflation's starting to go up, and in order to make homes affordable, they're going to have to start doing some more adjustable rate things to get people into homes. Right now, with interest rates super low, you're better off locking in a fixed rate. You would not want to go adjustable. Ignoring the risk is not a management method. Comprehensive coverage, that's all the extra stuff, the whatever wind, hail, trees falling on your cars and all that other stuff. Maybe hitting pigs. I don't know. I lost a pig lately. A deductible is not paid by the insurance company. So you're probably well aware of this. If you have a medical deductible and a car insurance deductible, it's the amount you got to put up front before the insurance kicks in, which is not covered in a standard homeowners policy. So obviously the flood insurance, right? Because everybody along that river, probably a lot of people. That's why floods are so devastating. If you live in an area, like a place I've lived in the South, the cheap land is in the lower flood zone. So when you see a hurricane come and it seems like, wow, all these poor people were affected, that's because they bought land that they could afford, and the only land they could afford was in a known flood area. So if you have to get flood insurance, it can be pricey. So that's definitely something you want to check on. And again, maybe that's why you want to use a real estate agent. I bought in a flood zone. I've done it a couple times, and anyway, got it rezoned one time, and another time I just had to suck it up because it was in Florida, and the house had previously flooded with hurricanes. So anyway, if you want to live on the water, that's what you got to do. To cover valuable property, you need a personal property floater. You might call it a rider. Anyway, the big picture is that if you've got any one category that seems, like you've got a lot in that one thing and you're concerned about being covered, talk to the insurance agent or, God forbid, read the policy, and you may find out that, you need to get a separate policy to cover those higher priced items. Best way to reduce your homeowner's insurance is back to that deductible. Get a higher deductible. And again, I'm dealing with a homeowner's thing right now. It's a strange claim, but anyway, it's by having a high deductible, I haven't filed a claim in 5 years, and so my rates are still fairly low. But after this claim may go a little higher. Health insurance is expensive. Health insurance is a mess as well. If you can get some sort of employer coverage, that's probably the best way to do it because it's going to be a group policy. It's going to be subsidized generally by the employer. If you have to go in the insurance market itself, some sort of Obamacare, Affordable Care Act, uh, yeah, that thing is not it's not up to speed just yet. All right. Well, I was going to put all the pups outside, but it seems like they settled down, so we'll continue on. Life insurance, big picture life insurance. There's a lot of money to be made in terms of salesmanship on this stuff. There's a lot of commissions to be made. So you may have people, or you may exactly, or not exactly, you may, yourself be somebody, who's pushing life insurance. And I'm not here to make any enemies, but I will tell you that think of life insurance as just a tool. It's something to, in case you happen to die early, the people that you leave behind are you're trying to minimize the impact of your early departure upon them. Now, inherent in that definition means what's your situation? If you are, a young parent with a couple, three kids, and maybe, your partner, spouse, whatever, is not college educated and you're going to college, and so you're the primary person bringing in the money, and basically things are going to be really altered if you happen to die. Well, then you need a lot of insurance. Conversely, if you're somebody who had a bunch of kids but they're all grown, they're all through college, or you had a big mortgage but you paid off the house, you don't need much insurance at all. And if you're older, insurance is based upon your likelihood of dying. So insurance is going to be super expensive at that point. And if you started saving for retirement when you're young, you probably have a pretty big nest egg set up. So you know what? Skip the insurance at that point. You don't need life insurance. It's a you're whatever. It's the situation with you being gone. It's not your money would go a lot farther. Let's say your insurance at that point is $500-600 a month. Your ones you leave behind, the beneficiaries, would be much better served if you put that $500 or $600 in investments and didn't put it away in insurance. Your return is going to be much, much higher. But if you're young, if you're that young person with, say, three kids and a need for $1 million worth of insurance, if you um, got that insurance and you're healthy, you don't smoke and all the rest of that, you can get $1 million for like $50. So it's super cheap. And so, anyway, that's the big picture. This is what I'm talking about is term life insurance. So there's different life insurance products out there, but term is the easiest to understand, and it's exactly what I'm talking about. It only is in effect when you're paying, and the minute you quit paying, then you have no insurance. There's other policies out there that are more complex that deal with, they're like a hybrid investment kind of thing. I'm going to put these pups outside before they kill me. So the terms that we're talking about in here, life insurance to a beneficiary, that's the person who's going to get the money if you happen to pass away. Let me get this back down. Role in life insurance, just like I said, it's for the survivors. Leave money to the heirs, beneficiaries, same folks. Psychology, yeah. Role of life insurance companies, help clients. They're not, they're on commission, so they're, this is their livelihood, and I don't begrudge them for that, but they're always going to be more, and they're going to most likely want to recommend products that blend insurance and investments. And insurance companies are really good at doing insurance, and not so good at doing investments. So, if you have $1,000 and you invest it just generically with, an investment company, um, you're going to have quite a bit more wealth than if you give it to an insurance company and let them invest it. I mean, their track records speak for themselves. So that's what I'm not saying to, you know, let's say they want to do this young person, you can do the term life insurance and it's 50 or $100 for $1 million worth of coverage. But they recommend this other product that's much more comprehensive, this universal life, and it's an investment and it ends up with cash value and it's like 600 or $700. You're better off in just about every case to get that term life insurance, pay the 50 or $100 policy, and get that 500 or whatever dollars you saved and put that in investments, and your return at the end of your life will be much, much higher. So anyway, applying for life insurance, yep, medical, lifestyle history. And there are things, this is where a lot of these privacy issues are certainly important. We're in a strange time right now where they want you to, divulge all this medical information, and that may come back to haunt you. The insurance companies would love to know. They'd love to have your DNA to be able to do some sort of profile and find out what your propensity is for cancer or other, diseases. They want to know everything. And so be careful with that. If you're judged with having a pre-existing condition, you may find yourself uninsurable. So it's important to guard not only your information but those of everybody else's. It's not their business. Now, if you do go, and I've done this before, I was flying and we got sorted for. We were flying in Kosovo at the time, and I'd flown a bunch of combat missions before, but we were flying one in particular, and we just had somebody shot down. And so I took out $3 million policies on myself because they ask you all these questions about, do you smoke? Do you scuba dive? Do you skydive? Not, are you going to war next week? And so anyway, I took out all these policies, and it was, funny. They were kind of suspicious, but they wouldn't have sold me the policies. But there was a lady who showed up at the house. She was dressed up like a nurse, probably not actually a nurse, but she drew my blood and wanted to talk to me about different stuff. And anyway, it's interesting. They do want to know who they're insuring, and they want to ask you a bunch of probing questions. Some are legitimate, some are not. Term life insurance. This is what I was talking about. Very easy. Premiums on the term issue, paid monthly, quarterly, semi-annually, or annually. Very easy to understand. You pay for a certain amount of time for a certain amount of coverage. The longer the term, the higher the premium. Yeah, as you get older, it's going to get more expensive. The older the policy age, that's also greater amount of coverage. That's obvious. Higher for males and females. Males are in riskier professions generally. They tend to, I mean, these guys are all about statistics. They look at you not as a person. They look at you as a risk and in a category. And, anyway, men tend to die earlier. Higher for smokers, higher for those with medical problems. So certainly. And it just gets astronomical. And so, the good news is that if you've done things right, roundabout in here, everybody's different, but a lot of those needs that you were saving for, this catastrophic thing about the kids going to school, about, your home, here you're almost ready to retire. You're not even going to be bringing in an income, so there's nothing to really insure against. And here they own you because they know, they can charge you pretty much what they want because your propensity to die is there. And anyway, male versus female. Yep. So anyway, these are just, generic charts. Smokers, certainly. So there's different ways. It's all marketing. They can set it up however they want. They can say, We're going to keep the benefits. Your payment's going to remain the same, but the benefit's going to be reduced over time. They can also, you'll see this with credit life insurance or mortgage life insurance. Let's say you're, giving somebody writing a mortgage to you. It's Wells Fargo or Freedom or whoever, and they want to make sure that their loan is going to get paid off in the event of your death. So when you go to get the mortgage, they'll get a very small insurance policy to cover the value of the home. So not very small, but enough to cover the mortgage. And they'll act like it's all about you. Oh, this is great. It's going to help with your errors and all that stuff, and it will. But it also simplifies their life a lot because they know their loan is covered, and they're making you pay for a little life insurance policy to cover their interest. Group, just like health insurance, same sort of thing. Um, Usually doesn't involve a physical. If you go, when like my case where I said I need $1 million insurance and you act like you're in a hurry and stuff, they're pretty suspicious. They think this guy knows he's got some illness and he's trying to get one over on us. And but in a group situation, they typically um, don't have physicals and things like that. They may, but it's not as stringent as an individual policy. So now we get into some of these different things. Now these definitions for like whole life and permanent insurance and it, they're kind of confusing on purpose. And that way, you need an agent, a licensed agent, to explain this to you. They're providing a service to you. Fair enough, but it doesn't need to be this confusing, and you don't necessarily need these products. So all I've ever had is term, and it's worked out quite well for me, and I think it works out well for another. And there's a video that I'll show you, where most people, if you're one of these financial, podcast kind of online radio guys, Dave Ramsey, Suze Orman, one of those people, they're pretty much in agreement as well with what I'm saying. That term life is typically the better way to go. And that's again with the caveat that you're going to get that extra money and not just blow it, but you're going to be investing. It's a gets back to our opportunity cost thing. If you're spending $600 a month on whole life insurance, you're probably not spending as much as you were on investments. So spend less on just get the term life, save that money, and put the rest in investments. So whole life very substantially same factors as term. Again, yeah, if you're older, you want more. Yeah, it's all going to get more. Um, and sometimes limited payment policy, but you're insured for life. Well, what you've done is you've given them a whole chunk of money, and they're going to give it back to you at some point after they've used it for a while. But the premiums are going to be starkly different. And when I'm talking about the $50 a month versus the $600 a month is pretty realistic. Comparisons to term, much higher premiums, accumulate savings, and remain constant. Yep. Universal. So term or whole life kind of gets a little bit of heat because sometimes they aren't as competitive. They're not making as much money in terms of investments, so they move it around a little bit. They come up with universal life or variable life where they can invest things and maybe be more competitive. But all these different hybrid things. But there's if you go to New York Life, Universal Life may mean one thing. If you go to you know Mutual of Omaha, it may mean something else. It's not like these things are necessarily in code. There's going to be nuances between the company, which again makes it a little bit more confusing. Trying to figure out how much life insurance you need. I kind of gave you an insight into that. Figure out what is, if you happen to die, um, you know, obviously the family is going to be quite disrupted. Now, if you're just a single person, again, do you need insurance? Probably not. Not unless you've got kids out there somewhere or something else. But yeah. But if you're somebody, you've got somebody dependent upon you, then you want to look at how that is financially going to impact upon them, and get the amount of coverage that's going to correct it. Now here's this income method. They have these different methods. This is kind of illogical in my mind. Method determines how much you need. So 10 times your annual income. So 400,000. What do you own a house? Do you have one kid or five kids? I mean, all those things are going to impact it that aren't considered here. Easy, but doesn't consider. Yeah, exactly. Easy, is kind of worthless in this case. Budget method, um, based on household expected future expenses. So better, yeah. Job marketability. So yeah, is he or she college educated? Is he or she trained? Can they just, if within a couple of years, can they just go out and re-enter the job market, or if they've never done that? And it's going to be a huge impact. Existing savings. So this is, obviously quite a bit more comprehensive. Um, so this is more realistic. Internet. Uh, you know, internet, it can be garbage. Internet, enough to when they just say, "Oh, use the internet," like it's magic. Internet may have one that just multiplies your income, like that first model. The internet probably is going to have a calculator in there that's going to look at, more inclusive things to the budget method. Um, anyway, inflation, yeah, underestimate your needs. Anyway, you need to be prepared. I mean, um, some of these things can be overcome. If you look at kind of the simple way would be what I was talking about. How much is it going to take? Ideally, if you're still here, you would want to probably, um, you know, obviously pay for your house throughout the course of it. So if you got a house, a mortgage out there, and you're gone, well, your house is worth 3,000. You probably need 3,000, and then kids' education, maybe 1,000 each, and then income for a certain number of years, maybe whatever. And you write all this down, and you come up, um, perhaps using a calculator that you might find on one of the investment sites, and you're probably going to come up with something like $1 million, something like that, which would be fine. And you may say, this is pretty inexpensive. Why don't I go, I'll spend $100 a month and I'll have peace of mind because I know I'm going to have more than enough money. Fair enough. And then just, with the understanding that as you get older, that that same amount of coverage is going to cost you considerably more. But again, your children are going to have less time to, you're going to have less time before they leave the home, and you're going to have equity in that house and the rest of it. Um, yep, these guys are getting a little dated. Apps tend to go out of fashion. Some of these life insurance guys, they may drive you to the solution that they want, some sort of universal life or something like that, because there's a lot more money in that. Term life, you could go on right now, no agent, and knock it out in a half an hour. And so, I have a brother-in-law and a nephew who both are in the insurance business, and they have what they call a book, and it's all their clients, and every time that client renews year after year. My brother-in-law, he's a winemaker. He hasn't done insurance for 15 years now, but he still gets paid. Every time they renew, he gets money. So, don't be these people are incentivized to get you into the most complex and expensive product they can. So, just determining the amount of life insurance. Yep. Needs. Yep. College education. So I think we've hit on this. Beneficiary. That's that person who's going to get the money. Grace period. Sometimes grace period can be applied in different ways. It may be, you're unable to pay for a year or so, and there's some stipulation in the policy where you still have insurance in force, even though your coverage lapses. Or it may be for the insurance company where you have really no benefits for the first year. So that theory of, oh, you've got some deadly disease and you run out and get a bunch of insurance, uh, the insurance company may be protected since you are not covered for that period. Living benefits, this kind of is a, I wouldn't say it's that new now. It's been around for a while, but if you're diagnosed as terminally ill, um, and obviously this has got to all be validated, but in some cases you can, you've got say $1 million insurance policy that's going to pay off upon your death. The insurance company may, release some of that money while you're still living to help you enjoy the end of your life and take care of some of the issues before you pass on. Non-forfeiture clause. This has to do with these whole life, these policies that have value in them. And if they do have value, and we can also take a loan against it. And incontestability, meaning that the insurance company can't fight you over it. They can't say, oh, you had an existing condition 2 or 3 years into the policy. They can't argue and say, oh, you didn't disclose something. Renewability option. Yeah. That's can be with term life insurance. You may want a renewability option, or at least find out what it is, so that let's say you have term insurance and you've had it for 5 years, and you want to get it for another five. What's the option in terms of renewing that? Because you're going to be a little bit older now, and your rates are probably going to be higher, but you at least want to make sure that you can get the policy. Conversion. So convert your term into a whole life policy for the rest of your life. Again, that's kind of the way they've written that is, do you need insurance for the rest of your life? Settlement options, the way the benefits can be dispersed. Lump sum or installment payments. So we're usually familiar with this, and you know how the time value of money works. And, you see this from like lottery things. Well, pay whatever, $1 million, or, $100,000 every year for 15 years, which would actually equate to 1.5 million, but because of the time value of money, it's cheaper for them. So again, they're preying upon people who can't do math. Interest payments. Yep, paying interest to the beneficiary if you choose not to accept, the whole lump sum right then. Selecting an insurance company, it ought to be somebody you've heard of before. There is a company, AM Best. So you hear some of these financial companies like Standard and Poor's or Fitch, or some of these companies that, they're Morningstar for mutual funds. And what they are is they're companies that rate other companies. And AM Best, what they would do is they, give a ranking to an insurance company based upon their solvency. Make sure that they have the money when you go to collect. Investing fundamentals. So we're done with life insurance. You'll see the video on that. Again, it's an individual thing. It's not a lifetime need. When you're older, hopefully you shouldn't need life insurance, and if you did, it'd almost be unaffordable. So anyway, look at it as just a tool. Investing fundamentals. So to start investing, you should start, obviously as soon as possible. But if you're not, if you got money on a credit card, but you think you're going to invest, even the most optimistic investor would not anticipate that their, return is going to be as high as the credit card interest. Besides, if you make any money investing, it's going to be taxable too. So, yeah. So money market securities, that's more of a parking place. Those are government securities, paying, very little interest. Stocks, common stocks versus preferred stocks. I'm not going to spend too much time on this. It's a kind of a distraction when you're buying stock. There's probably two different types of stock. There's stocks that are growth stocks. There's many different classifications, but the two ones I'm going to talk about right now are growth and income. Okay, so growth stocks would be stocks that are younger companies that are making money, are looking forward to making money. They may not actually be making money at this point, but you're going to make money by the stock price appreciating. The stock, you're going to buy it for $15 and it's going to go to $60 or something like that. You're not looking at making money off of dividends because these companies aren't paying dividends. They're growth companies. And so they use that money, their earnings each year, to expand. Okay, then you get more mature companies and they're no longer expanding so much, and so their stock price is not necessarily going up much, but in order to entice investors, they pay a dividend. So what they do is they get their profits and they turn a portion of it over to their investors. So on income stocks, um, some of these companies don't pay dividends all the time. Sometimes it depends on their performance of the company. And in those cases, um, if a company's not going to pay a dividend, um, and you've got, say, if they've got two classes of shares, common and preferred, um, before they can pay dividends to the common stock people, they have to have paid them to the preferred stock people. For people, you know, generically looking at younger investors, and even I still don't invest in income stocks. I'm always in growth stocks. So this whole common stock versus preferred doesn't matter to me one bit because I'm not um, in a position where I'm relying on dividends. So anyway, don't get too wrapped up between common and preferred. But stock in general means that you own a portion of that company. If a company wants to grow or wants to function, they need investors, right? And they can get a loan from, from investors and sell bonds. So you don't, a person who owns a bond doesn't own any part of that company. They just have the company um, owing them money. But if they own stock, that represents a partial ownership in the firm, as does preferred stock, same thing. But this just the distinction between common and preferred only relates to dividend paying, and most companies don't. So I just disagree. I should just take this slide out because it just creates more confusion. Um, anyway, stock is stock in my mind. I never get involved in preferred or common. This is important though. Primary and secondary markets. So let's say I still work for a company, and I'm involved in their stock direct purchase program. They sell it to me for a 5% discount. And as soon as they sell it to me, I sell it the exact next day. This is first chance available. I just want the 5% profit. I have no interest in having stock in the company. But if they're going to offer it to me at a discount, I will take it and then I will sell it. But anyway, that when they buy stock directly from the company, that is primary. I'm buying it directly from the company, which is quite unusual. Normally, you're buying stock through, like, say, NASDAQ or the New York Stock Exchange or something like that. You're buying on a secondary market. You're buying shares that are already out there floating around. You're not buying directly from, say, Ford Motor Company. You're buying Ford Motor Company stock that was owned by somebody else, but it's not like it doesn't depreciate. There's no wear and tear on the thing. It's just stock. And so 99% of purchases are in the secondary markets. Um, IPOs can also happen where it's in a primary market, but getting in and on an IPO, again, you kind of have to sort of know people or be a big whale, have a lot of money. IPOs can be pretty challenging because you want to get in on the first day, and by the time you get it, it's typically already in the secondary market and it's already moved around a bit in terms of price. So secondary market, a market where existing stocks are traded. Types of investors. So institutional investors are big retirement funds, union funds, the PFD people for the state of Alaska. They're institutional guys. Portfolio managers. These are like the big mutual fund people. They have big big accounts as well. Almost the same sort of people. These guys are, directly represent their clients. These guys, they bundle them together and sell them typically as mutual funds. And then individual investors. This is kind of like you and me. They often call these guys retail investors, or, this would be like Wall Street bets kind of people would all be in individual investors. And day traders, this is should be thrown out as well. That's a method of trading. That's not a class. Day traders are typically individual investors, guys who, sit home and watch screens and trade back and forth. So I talked about bonds a little bit. Bond is a debt, served by a government agency or corporation. Mutual funds, if you're buying individual stocks, let's say you want to buy, you think for some reason solid state hard drives are, well, they're not old now, but that sort of technology. Or let's say solar. Let's say there's, for some reason you think, I mean, there's plenty of good reasons to think that again, it's getting kind of mature as well, but you think that's where you want to put your money. And you pick some individual company in solar. I guess Tesla was in on that or still is. And it's kind of a risky move to not only be right that, say, solar is going to take off, but also to be specifically right again that you were lucky enough to pick the individual company that's going to become the dominant player in there. A safer bet might be to have a little bit of stock in several companies involved in, say, the solar sector. And the easiest way to do that would be to buy a mutual fund. A mutual fund it's typically done by a big brokerage firm, and they'll have these different funds that'll set up, and they'll have, say, a sector fund that, sector would be, green energy or solar or whatever. And they've invested in a whole bunch of companies in that sector, and you buy into that fund rather than buying individual stocks from all the separate companies. They own all of those different stocks that they think are good. You look at that, you decide, yeah, that looks good to me. And so then you buy mutual fund shares, and indirectly you have ownership in all those different companies. And so you've got some diversification. Now you don't necessarily need to be right about the specific company because you're invested across the entire sector. So quite popular. Um, anyway, there's a lot more money in probably mutual funds than for retail investors. Most people are in mutual funds. If you've got a retirement plan, you're probably in some sort of mutual fund, and good product, and it doesn't take a lot of attention on your part because there's a mutual fund manager who buys and sells under that umbrella and does all that. They charge a bit of a fee, but if they're good, they're worth it. And then indexes, publicly traded indexes. We'll talk more about this again, where sometimes those mutual fund managers, they buy and sell, and they get paid pretty well, and they generate some commissions buying and selling, and they sometimes their fees start to eat into the profits. And we've been in a market that was just kind of steadily going up. So people have decided that rather than pay for all those management fees, why not just pay for a fund that buys a little bit of all these companies and then just basically doesn't trade anymore. And there'll be a uh, um, podcast that you'll listen to as part of the homework that will kind of explain this a little bit more. And it's just a different method. And then real estate. So you don't have to have one or the other. Typically, what I've always done is try to make some money in the stock market. And like I say, I tend to invest in growth companies. And when I do, get lucky and make some money in almost like speculative type investments, I will jump into get that money and put it into real estate to kind of solidify my gains and make it a little less volatile, because most real estate, again, you can buy a wide range of property, but it can be a pretty good investment. And then also it's an investment that you can use, especially if it's a, home. So more than just having a big balance sheet, you've got, someplace nice to live. So returns come through dividends or price appreciation. So kind of got ahead of myself a little bit when I was talking before, but yeah, when I talked about income stocks, those would be ones that pay dividends. Bigger, mature companies that are rolling their profits back out to their shareholders. And then growth companies, they're growing companies that are getting bigger. Their share price should be going up, and you're making your money through price appreciation. So growth stocks, substantial growth opportunities, income stocks, periodic income in the form of a large dividend. So investing in bonds, what you do with a bond is it's contrary to what you might think. When you see these big investment banks, they're not making big cash loans to big businesses typically. There's not that much money available and it's not going to be on that great of terms. What they'll typically do is, do the mergers and acquisitions, or they'll organize these bond sales. And what they'll do when they want to sell a bond, let's say a company doesn't want to sell stock, they don't want to dilute their ownership, they don't want to sell any equity, they want to keep it all, but they just want some money to operate, and so they'll offer a bond. And what they do with a bond is they'll do a bond offering and they'll say, give us 20,000 bucks and we'll pay you, 3 or 5% every year on your 20,000 bucks for 10 years. And at the end of whatever the term is, 10 or 20 years, you keep all that interest and we give you your 20 grand back. And, you size it up and you go, is that a good deal or is that not? So, anyway, that's what bonds do. Mutual funds is the same as a stock, can generate capital gain from shares may increase in value. Return from investing in real estate, yep, rental income, price appreciation, different ways to make money on that. They're trying to make this much more complex than it needs to be. Buy high, sell low, right? I mean, they're going to put all these acronyms in here. We're not going to deal with a bunch of formulas, but price when sold, price when purchased, return. We don't need a formula for, if you bought it at 35 bucks a share, just like we saw on the midterm exam, and you bought at 20, you sold for 35, you made 15 bucks. So that would have been the factor. If there's a dividend involved, well then yeah, you would figure out how much my monthly dividend was. So I made 15 bucks on the share appreciation, but if I got $5 a month or $5 a year on my dividend, then I'd add that in as well. So remember when I talked about long versus short term? So here it is again. So capital gains for investments held over 1 year or less, they just roll into your regular income. If you keep it more than a year, then it's long term. So, maybe your ordinary income's being taxed at 28 and your capital gains are typically taxed at 15. So about half. And that's what they're showing you here. Short-term cap, so this person's in a 35% tax bracket. This is where tax brackets come into effect on short-term. Long-term, there's some caveats here, but typically 15 for most people. Measuring investments risk. What you want to, not all risk is bad. I mean, a little bit of risk is has quite a bit of reward. So what you want to make sure is that you know what the risk is. If you're buying junk bonds, or called high yield bonds, the reason why they're called that, the reason why they're paying a high yield is because they have to, because they won't get investors to invest unless they offer quite a bit of money. So, if you hear somebody on the news saying, oh, I didn't know it was so risky and I was getting 20% a year. Well, if you're getting 20% a year, you should have known it was pretty risky, because they would not be paying you 20% unless they had to. Um, Small firms, yep, but higher risk. So 9 out of 10, you know, Silicon Valley startups fail. IPOs may offer higher returns, but also IPOs are just difficult to get in on. You can't just, you know, show up with your $100 and go to your broker or go online and try and get into an IPO. It's not necessarily corrupt, but legally they can offer those to their preferred investors, which in most cases doesn't mean us. It means big institutional investors, and it's not going to make it down to the retail level. Risks, yeah, if you're getting a high yield bond, you know, there's a reason. You know, there's a bond rating agency out there that's looking at the risk, their propensity to pay, and if they don't have a very good likelihood of being able to pay it off, then you're going to get a fairly high return. If it's a large company with very little risk, you're not going to get much in the way of return. Mutual funds, you have to look at the underlying stocks. So it depends what it's comprised of. Um, yeah, it's the mutual funds are, you know, they are what they contain. And mutual funds, there's more mutual funds out there than there are individual companies. There's so many mutual funds out there, and you can find one for anything. You know, if you want to, let's say you want to invest in Vietnam, and you're, you know, you don't intend to go to Vietnam or do the currency things anytime soon, you can find a U.S. traded mutual fund company that probably, if not specifically Vietnam, in that sector. And you know, the sectors can be, I mentioned before about solar, but they can also be geographic. They can be international. They can be global. They can be, you know, all these different things. And international and global actually mean two different things. International means everywhere except for the United States, you know, the host country. If you say global, it means they can invest anywhere to include the United States. If you know, that's for U.S. sold funds. But there can be ones that are, you know, sustainable. There can be ones that are, um, you know, strictly one kind of technology. The defense sector, you can find one if you have reason to want it. Now, with mutual funds, you can also go to a company called Morningstar that does reviews and looks at their past gains and in terms of rating them. We'll talk more about that in subsequent lectures. Risk return among real estate investments. Yep, they could default and selecting investments. So we'll talk more about this as well. Learn. Yep. So when you borrow money to invest, that's called margin, right? So you can be leveraged, you can be trading on margin in the stock market. Typically not very wise. But borrowing to invest in real estate is typical. So it depends on the investment. To borrow money for speculative investments like borrowing money to buy Bitcoin, um, man, that could work out very well or very bad. So we'll talk more about that kind of stuff on subsequent because we're gonna split each one of this intro to investing part was kind of the overview. We're gonna spend a little bit of time on mutual funds, a little bit of time on stocks and on bonds. So this isn't all you're gonna get. We'll go in detail on that. But now that we've got the midterm behind us, it's time to start looking at the personal finance project, the term project. So this is nothing new. This is right out of the syllabus. But big picture is that people get very frustrated because they want just a cookie cutter approach with a series of steps and do this, do that. It's not like that. This is your individual financial plan. So if I mandated that, it would not work out well because then you'd end up with a plan that's not tailored to your specific situation, which is, what we want. So it does have to be, this 4 to 5 pages long, and in the rest of it, it can't just be a series of bullet points. But other than that, um, it's completely up to yourself. So if you're having trouble getting started on this, what I would do is go to some mutual fund sites. So I'll run through some of this right now, not necessarily mutual fund. When I say that, I mean like brokerage companies and the rest of it. I'll show you here in a second. But anyway, college savings plans. So this bit is maybe a little bit like a checklist, but again, for people who might be having children, if you're somebody who's single and has no intention to do that, then it's not a big deal. Or maybe you're somebody without student loans, so you're not going to worry about that. You know, Social Security, you kind of need to look at that because people are under this illusion that, oh yeah, I don't need to save for retirement because I got Social Security. Not so fast. It's may not even be there when you get ready for retirement. Life insurance, so we talked on that a little bit. Look at what's out there and figure out kind of what you think you'll need. Stocks, bonds, mutual funds. You don't have to have them all. I haven't had bonds for a long, long time. Back in a certain time, this was, and we may be going into this period, but when inflation was high, I was getting 8% on a short-term bond, and it was money. I mean, 8% was pretty good. And anyway, now bonds are not paying that much because interest rates aren't that high. Interest rates will probably creep up as inflation goes. Career field, you ought to know kind of what you'll be getting paid for your prospective career. And again, examples would be like say a veterinarian kind of guy. I've met so many veterinarians that are so disgruntled because they went to all this med school, the equivalent of like to be an MD kind of stuff. There's lots of unhappy doctors too, but doctors tend to get paid pretty well. Veterinarians tend to go to pretty much the same amount of school almost, and they don't get paid that well because, there's just not as much money in it and people don't have insurance and the rest of that. So, you know, the time to figure out what your chosen career field gets paid is now, and decide whether you can live with that, or perhaps you've really got a passion for being a barber or something. The wealthy barber, it's about a guy who realized that's what he wants to do, and he's not going to make that much in income, so he's going to have to be smart with his investments, and he ends up being a multimillionaire. So and then also, you know is there a pension plan? What's the retirement situation? Military, that's kind of more specific. Tax deferred. So how are you going to keep the money? We'll talk more about that. And anyway, so let's just look at a site. Fidelity is a pretty good company. I'll close some of this stuff out. Oh. So you can go to Fidelity, you go to TD Ameritrade, you go to a lot of different companies and look at their stuff. I'm not going to log in because you don't necessarily need to. Um, but on any of these sites, they're going to have a whole bunch of information. So this is when you actually have an account with them, planning advice, but creating your plan, building your savings, wealth management, retirement, life events. These are all resources. You start going through and you want to know, you know, how am I going to get to whatever point? These guys are very eager to kind of give you some information. Now you don't have to jump in here and get a password and all the rest of that stuff, get bombarded with a bunch of spam, but you can look through, um, build a plan. Yeah. This will explain a little bit about mutual funds. They'll tell you in detail how things are rated. Remember I talked about Morningstar. So again, you don't necessarily want to take, Fidelity's, they don't necessarily have fiduciary interest, right? They're looking at things from their company's perspective. Morningstar is not part of Fidelity, so their rankings are going to be a little bit more valuable than Fidelity's own rankings because they don't have a dog in the fight. Um, Mutual funds, retirement, and IRAs. Again, they keep wanting you to open something, but typically there's some information in here to help you out, or you're perfectly capable of going on Google and just looking up some of these key terms. Any one of these companies is going to have this same sort of stuff. I'll try and guide you through. Of course, they're going to give you a slant on why you should do it with their company, but a lot of it's pretty educational. Calculators, if you're trying to figure out how much money I'm going to need for whatever, you can go through here and you can enter in some data and come up with an amount, yeah, first name, whatever. Put something in there and put some dates in here and maybe it prints you out a little chart and it's perfectly appropriate to cut and paste that and put it into your paper. And it's just you need to find out what's available and come up with a plan. So you're going to go through, this is how I'm going to save for retirement. Um, this is what, and again, a lot of it is obviously I realize you don't know. Well, I'm in college right now. I'm not, I'm completely single. I haven't, but so that's why the one of the caveats back into the paper is, into the syllabus is saying put yourself at a, 5, 10 years out when you're and what scenario do you see yourself in, the most likely scenario, and plan for that. So that's the value of it is to, fast forward yourself to a point in life, or maybe you're already there. Maybe you're already have a career and you're just finishing up a degree and you're at a point where you can come up with a plan right now. So it's not, you know, it's meant for you to get the most out of it, pardon me, as possible. Just to spread the wealth. There's a million of these companies, Vanguard. They're always gonna have flashy websites and touchy feely stuff. Here they've got a bunch of sites. So probably personal investors is where we're looking at. And you notice, again, get back into the vice. Here they're talking about, college and emergency funds, saving goals, retirement planning, Social Security, you know. They'll link you up and they'll tell you, what you need to know about Social Security. And what they're trying to tell you is, you know, a safety net. Safety net, it doesn't mean it's going to be comfortable. Payroll taxes, you'll get some education out of it. What is Social Security? Um, go through here and they'll give you some specifics. And they'll be honest with you. And you get down here to the bottom, you're going to go, wow, that's, helpful. It is maybe a safety net, but it's not something I want to completely rely upon. And so, anyway, and yeah, they'll give you links to Social Security offices. They want you to know kind of what you're up against. And they're confident enough in their products that they think, regardless of Social Security, you're going to come to Vanguard, Fidelity, Ameritrade. You're going to come to somebody else to go, yeah, I want to get a little bit more out of life. I mean, because it's a plan, right? You're hoping things go well, and so you got to have some sort of plan. If you just stumble through it, you're going to end up with in Social Security, and then you're going to find out, it's not quite what I wanted, and you're, in the dark eating top ramen and not enjoying your later years. So anyway, enough said. This was a long one. Oof. All right. Till next week.